Hi, Harry here with the Rant on August 22nd. Let's take a step back here and, where are we in this entire very perverted economic process since the governments took over the economy in 2008 forward and that deep downturn, which, by the way, give me a little credit. I was predicting that in my speeches back in the early 80s in my first book, A Power to Predict and Great Boom Ahead I was saying peak long-term baby boom spending, late 2007, and then a long slowdown from 2008 to 22. And so that's exactly what happened. Deepest downturn in decades. What happens this time, though, very, very different from any time in the past. The Federal Reserve and the government just step in and say, no way we're having a deep downturn. And Ben Bernanke was the Fed chairman, and his thesis was the Great Depression. And he saw what I saw. 2008 looked like 1930, okay? And it was, and it would have been. So let's start with what should have happened. Instead of that recession bottoming in March of 2009 for the stock market and maybe mid-2009 for the economy, that downturn should have lasted probably into around mid-2010. More similar to what happened from 1930 to 32 in the stock market and the economy, okay? That should have gone deeper and longer. Not a lot deeper, but particularly longer, okay? And then we got to come out of that with stimulus and everything else. And we should have had a second downturn, which we clearly didn't, from around in the bottom of the Gen X down cycle into late 2022, 23, okay? So that would have naturally come on the decennial cycle from, let's say, late 2019, early 2020, into late 2022 for the stock market and into 2023 for the economy. Okay, so we should have seen another strong downturn. Stocks go even lower than they did in 2009, and even back then they would have gone lower if they hadn't stopped it. So we would have had deeper, longer downturn, but we would have been coming out of it healthy. Okay, from 2023, 24 forward, okay? So we do have demographics back behind us. Again, whole reason we had a major long-term bubble in stocks. We had the biggest generation in history drive the longest, strongest boom as predicted, okay? And so now the millennials are kicking in, okay? Since I would call it late 2023 by my best estimates, forward, they're going to see a first surge into 2037, which we're in, and then it's a long plateau. This is very strange generation cycle, but a long plateau up and down into all the way out 2054 before they turn the broader. Now I'm defining the broader generation, not just what they call millennials now. I see it all as big baby boom and big second baby boom, okay? Millennial led, okay? So that's what should have happened. Instead, we got this 29 trillion in stimulus, and I've outlined in the newsletter lately, that was an average combined fiscal and monetary stimulus, 7.8% a year for 16 years from 2008 forward until now, okay? Going on 17, okay? That's just massive. And think, okay, well, but what did we get for that? Average 2.2% inflation adjusted or real growth. So if you're pouring, say, 8% in the economy to get about 2% back, then first of all, it shows how weak the economy would have been without the stimulus. And also, it's a bad deal. Okay, that's not a good deal to put that much stimulus in and get that little growth out, okay? And of course, there has to be consequences for this. Now, and here's the most important point. We have not really seen these consequences yet, okay? So that's the multi-trillion dollar question. Do these consequences hit? And if they do hit, now is a good time, okay? I mean, we've had a rebound, strong rebound in stocks, new highs and stuff. It's starting to weaken. But if we do get now a strong crash from the second largest and longer bubble bursting, okay? And again, there's no way this bubble's not going to burst. Doesn't matter good times or bad times. A bubble this stream, I mean, the first bubble burst from 2000 to 2002, tech burst 78% for the NASDAQ when we were in the middle of the baby boom boom, okay? And low inflation and all these positive trends, okay? So this bubble has to burst. This is a good time for it to do it, okay? So I'm assuming, and it looks like the markets may have peaked in August here, okay? Just recently, QQQ and S&P 500. Or at worst, we get a little correction here, which we're in, and we get one more bump up into September, October. That would be more normal. This is why I don't think that's likely to be the case. If I'm the market and I want to fool the most people, and believe me, as I always stress, in the short term, the market is not your friend. It's driven by the smart money, and the smart money is even more not your friend, okay? They want to take money from you, okay? So I would want this market to peak and start to turn around down in August before people expect it maybe to peak in September, October. So again, I think the highest chance we've just seen a peak in stocks finally in this 100% artificial longest bubble, or we could get one more little run into, say, September, October, probably more likely September, and go down. And then the question, and there's no way to perfectly answer this one, how big a crash or correction will we get this time? Again, there's no cycle for it. No 4-year cycle, no decennial cycle, no generation spending cycle down. Even the only cycle that's down long term is the 45 and 90 year, which is a double of that, which makes it more extreme, super bubble cycle here. And that cycle is still down into about 2032 before it bottoms. So that's the primary cycle now. That's the cycle that creates bubbles in the first place, usually 2 bubbles, 2000, and it should have been, say, 2021 should have been the second peak, and now it's going to be 2025, it looks like. So I still think we're going to get a big crash. If we had the greatest boom in history in stocks, particular, when the demographics were the worst, and even in the last stage from 2020 to 22, 23, when even the innovation and technology cycle was down, then we can get a major correction, not a minor correction, even when the demographic cycle's back up. But again, 45 and 90-year cycles still down for now, okay? So that's what I'm looking at. Debt levels obviously are weighing on the economy. Zombie companies, that's the problem here. It's hard to keep going, especially now that they're taking down the stimulus. They took down the balance sheet 2.2 trillion and a little more is drifting off, okay? That's the first tightening, but they didn't stop the deficit. That's still at about 2 trillion a year. That's 6-7% of GDP. That's still substantial stimulus, okay? So is this enough for the stock market to get enough momentum down that we do have a major crash? One way or the other, folks, it's very simple. This is not a time to be in the stock markets hoping they can keep this bubble going even farther when they've stretched it beyond. We will watch this. This is the end of this year, into late this year, is the optimum time for the first crash, okay? And remember, and I've done extensive analysis on this more than anybody on earth, the first crash after major bubbles is typically 42% in about 3 months, okay? And it can be 28 to 50, and this one should only be on the higher side since the bubble is so stretched and so much bigger. So we could see 40 to 50% crash in the S&P 500, or even more so, the QQQs or the NASDAQ 100 or the NASDAQ, okay? So I would say best estimate here, this first crash should be at least 40% in the S&P 500 and more like 50%, even 55%. First crash, just the first 2, 3, 4 months on the NASDAQ and QQQs. So that's the place. If you want to be short here, okay, and everybody should be out, okay? I've warned about this long enough. If you want to play this short, don't get greedy, okay? SQQQ is the highest volume ETF to short this thing, but buy 30, 40% of it. Buy a third to make it 100% short, because downturns come faster than bull markets expand, okay? So they already are more volatile, okay? We could get 40 to 50% crash by the end of the year, in the next 2, 3, 4 months. That would never happen in a bull market on the way up 50% in 2, 3, 4 months, okay, or extremely rare. So you don't have to get leveraged. If you're a trader and you want to, fine, but at least understand how leveraged you are and be quick to correct it if you're wrong. So this is a time to be normal short the stock market, or just out and waiting in TLT, or if you're just going to buy bonds direct through your stockbroker or whatever, or yourself, the 30-year treasury bond would be the ideal thing to just sit through this whole thing. You have to understand, I've been stressing this, you're not going to see big gains. This is going to come slowly at first, but when the downturn really gets bad, these treasury bonds will explode in value like they did in the second half of 2008 at the worst, okay? The ideal strategy is to start out more modestly normal short stocks, like just buy 1/3 of SQQQ, okay? It is a good simple play here. That'll put you one time short the QQQ of the NASDAQ 100. And I'd rather be short the NASDAQ than the S&P because it's going to have a little more downside hoof, okay? And then after that first crash, we can start stepping more. First of all, you get out and let that bounce. You could get a 50% retracement. And in that time, then you start stepping into the treasury bonds or TLT. And then after bounce, you could get short stocks again. And again, you don't have to go overboard. So that's where we're at in this out. Be either cash or treasury bonds. If you're just sitting long term, that's the safest place to be. The bonds will pay off slowly and then big time. Or if you're a more aggressive investor trader, this is the time to be like single short stocks and just wait for that first crash. And it should be at least 40% this time, folks, and probably 50% if you're in the QQQ or the SQQQ buying a third, okay? So when it gets down that much, then you can kind of pull out, we can reevaluate, wait for a bounce, and reposition in a combination of short stocks and treasury bonds. But again, for the safest people who want to sleep at night, either you can be in treasury bills making 4.5%, although that's going to shrink, okay, down towards zero or negative, or better, be in just the TLT or 30-year treasury bonds and just sit and sleep through this whole thing and know that the worse the markets get, the better those bonds are going to do. But again, don't forget, stocks are going to do best in the first round. They hit hardest first. The bonds benefit the best towards the later part. So take that in account in your more conservative or liberal strategy. I can't spell out a strategy for everybody because we got a whole spectrum here following me, okay? So stock short best modestly, and then bonds increasingly TLT, 30-year treasury bonds after this first crash. And then this will work to our advantage when most people finally get blindsided after finally thinking the Fed's got our backs, government's got our backs, and we don't have to worry about serious downturns again. That's the same thing people have felt at every major top in history, including 1929 and including recent tops like 2000 and 2007. So again, I'll keep you updated. Critical time, get serious, decide what you need to do here, and do it from here on out. There's no time to waste here. This next crash could happen strongly and could come very quickly, and nobody's going to expect that. And while I have you today, be on the lookout for our Labor Day special offer from contributing editor John Del Vecchio. His fast profit system is a forensic accounting approach to identifying the best stocks to buy and, most important here, to sell. Since 2010, he's had a 1,792% return versus the already astounding 536% market return. If you're interested in this, email us at info@hsdent.com and write on it FAST, capital letters, FAST. Thanks.